Picture a trade so large it stops making sense. A Chinese billionaire is short about 450 metric tons of silver on Shanghai futures. That is not a typo you can ignore. The exchange reportedly holds about 318 metric tons in inventory. His short is bigger than the entire warehouse story. It is bigger by a huge margin. Some quick math says the position overshoots available metal by roughly 40%. That is not a cute hedge. That is a fight with physics wearing a suit. Meanwhile, in New York, the COMEX story rhymes. March open interest is enormous on paper. People track something like 366 million ounces in play. Registered metal available to deliver is far smaller. Think on the order of about 102 million ounces in the common reporting band. That is roughly a 3.6 to 1 mismatch. Some people round it and call it worse. Either way, it is not cozy. Two of the world's biggest silver venues are stressed at the same time in the same month. March delivery is not a fantasy date on a calendar. It is a deadline where promises meet metal. Someone is about to be very exposed or very broke. If you are new here, think of March as a final exam for promises. The market has been copying homework for years. Delivery season is when the teacher collects the paper. And when you see why nobody can casually bail out both, you understand why March 2026 matters. This is the part where people ask a fair question. Why should you care if you never trade futures? Because the price on your screen is built on a market that assumes delivery is mostly a myth. If that myth breaks, the ripples hit portfolios, and they hit the real economy in weird ways. Insurance costs change. Supplier contracts change. The story people tell about safe assets changes. My name is Max. I run Max Invests. I built this channel for people who want finance education without getting talked down to. I have spent years watching commodity inventories, exchange rules, and policy shifts so you do not have to. My goal is simple. When a headline screams, I want you to know what actually moved. If you want the plain English version before the headlines panic, drop where you think silver finishes 2026 in the comments and subscribe to Max Invests. I read the notes people leave. They shape what I cover next. Here is the thesis in one breath. Silver is not just tight on a headline. It is in a multi-year structural deficit. The world keeps using more silver than it pulls out of the ground. Now, two major exchanges are staring at a March delivery crunch where the math gets ugly fast. I am going to walk you through how we got here, who the big players are, what happened in January that exposed the machinery, and 3 scenarios if delivery does not behave. I will also translate the scary acronyms into kitchen table language because finance loves costumes. But first you need one mindset shift. Most people hear silver and think coins and jewelry. That is the trap. Silver is not just a story you tell at parties. It is a line item inside factories. Industrial buyers do not care about your favorite meme chart. They care about grams and delivery dates. When I say futures, I mean contracts that trade on a screen. When I say registered inventory, I mean metal eligible to back delivery in the warehouse system, people track. Those two ideas are not the same thing. One is a promise. One is a pallet. Silver is the most electrically conductive element on the periodic table in practical use. Solar panels need real grams in every module. Electric vehicles use far more silver than old combustion cars. Data centers powering the AI build-out run on connections that rely on silver in the real world. Every time somebody says AI is just software, I want you to picture heat and power and metal. Software still sits on hardware. Hardware still sits on supply chains. Supply chains still negotiate in the physical world. This is not optional demand you can wish away. A lot of it is locked in by manufacturing contracts signed earlier. You cannot substitute it overnight. You cannot print it at a keyboard. You cannot invent inventory that does not exist. Recycling helps, but it does not replace a missing mine. A lot of silver still arrives as a cousin output next to other metals people are chasing. That means supply response is clumsy even when price screams. Also remember, above-ground silver is not the same as above-ground trust. People can own claims. Claims can cluster in the same places. When everyone runs at once, the line gets ugly fast. That is why I keep returning to warehouses and delivery months. They are boring words until they are not. People love to say price fixes everything. Sometimes price fixes the next decade, not the next quarter. If you are a utility planner or an auto planner, you do not get to pause reality because charts look scary. You still need inputs. Silver is one of those inputs that sneaks into everything once you start electrifying the world with seriousness. On the supply side, new silver mines take years. People throw around 7 to 10 years to bring serious supply online. Even after a huge price run, the response arrives slowly. Some supply estimates for 26 land near about 1.05 billion ounces. Demand still exceeds that by a big chunk. Think on the order of about 200 million ounces in the rough gap people argue about. That is multiple years of consecutive deficits. 6 years in a row is not a cute blip. It is a structural fracture wearing a polite smile. And the exchanges sitting on top of that fracture are about to feel the weight. If you want one more plain English frame, think of a bathtub. Demand is the faucet. Mining and recycling are the drain fighting back. For years, the faucet has been winning. That does not mean price only goes up. It means stress shows up in weird places first. Warehouses and delivery months are weird places. Key idea: deficits are quiet until delivery gets loud. Now let me take you through the first domino. A billionaire-class trader built a massive short position on the Shanghai Futures Exchange. Call it about 440 to 460 metric tons in the reporting band people fight about. Meanwhile, total SHFE inventory sits near 315 to 325 metric tons, depending on the day you snapshot. Do that subtraction in your head. The short can exceed everything in the warehouse. If silver rips higher, a naked short can face brutal losses. If he tries to cover, he needs more metal than exists on site. If counterparties want delivery, the exchange can hit a wall. That is a squeeze setup people recognize from textbooks. Except it is not a tiny fund in the corner. It is exchange scale pain. Futures markets use margin like a security deposit. When volatility spikes, exchanges can raise margin fast. That is not a moral statement. It is a liquidity weapon. It forces people to post more cash or exit positions. Exits can become a stampede when everyone runs for the door at once. That is how you get violent price moves, even when the long-term story did not change. Think about the Hunt brothers in 1980. They tried to corner silver by going long. This is a mirror image, a massive short that exceeds what is available. Both extremes can threaten the credibility of a market. The Hunts broke rules and headlines. This story breaks inventory arithmetic. I am not here to turn one trader into a cartoon villain. Markets are messy and people take risk for a living. I am here to show you when risk stops being private and starts being systemic. Second domino is the COMEX registered crisis. Remember, open interest is how many contracts still trade open. It is not the same as metal sitting in a vault. Registered is the metal eligible for delivery in the reporting system people obsess over. In 2020, registered silver near 330 million ounces was a different world. By early 2026, deliverable registered metal collapsed toward a band like 82 to 102 million ounces. That is a brutal drawdown in plain English. Call it a 75% class decline if you want a headline. In the first week of January 2026 alone, some reports highlight tens of millions of ounces moving. One scary week, people cite north of 33 million ounces. That can be a huge share of what is left registered. Normal January delivery noise is tiny by comparison. Some years people talk about 1 to 2 million ounces. This January, some trackers talk about 40 million plus. That is not a rounding error. That is a demand spike screaming something changed. February did not magically calm the room either. People track elevated delivery behavior there too. Some traders treat that as a continuation knock. Some treat it as a warning that March is not the only risk window. Either way, calm is not the vibe. If you want a simple mental model, think of registered metal like cash in an ATM. Open interest is like people standing in line with withdrawal requests that could turn real. March open interest still sits huge in contract terms. Translate the contracts and people get a band like 425 to 528 million ounces of notional demand. Stack that next to maybe 102 million ounces available to deliver in the common headline. Paper to physical ratios often land near 4 to 1 up towards 6 to 1 depending what you count. Here is the sentence that matters for risk. If enough contracts stand for delivery, the exchange enters a zone people call default territory. Some analysts use a threshold near 28%. I am not saying it will happen. I am saying the math is not allowed to be boring anymore. Also remember, markets can kick the can sometimes. Rolling contracts and cash settlement tricks exist because exchanges want survival. The question is not whether Wall Street is clever. The question is whether clever can outrun inventory math forever. If this video is helping you see the plumbing, not just the ticker, subscribe to Max Invest so you do not miss the next breakdown. These stories move fast and I want you armed with clarity. Third domino is the part most retail never hears. It is also the domino that makes the story feel global instead of a single country fight. Shanghai already bailed out London once. In October 2025, the LBMA world faced real stress. London was staring at a delivery failure vibe, so Shanghai shipped silver west to prevent a collapse. China moved metal to save a Western market moment. That inventory did not get magically replaced afterward. SHFE drained its own cushion to help London breathe. Now SHFE is underwater with a giant short hanging over limited metal. The irony is almost poetic. China helped London, and then China's own venue looks fragile. There is no obvious next exchange with a secret mountain of spare silver to fix everything. No country is sitting on a mystery pile waiting to rescue March. If you made it this far, you already understand more than most casual investors about silver delivery. This is why people say there is no obvious spare tire left. If you are taking notes, keep one line blunt. Bailouts are not unlimited when everybody is short on inventory. Fourth domino is January 2026 shock energy. On January 29, silver tagged an all-time high near $121 to $122 per ounce in the Banned People site. The very next day, the CME raised margin requirements. Think 11% up toward 15%. By January 31, silver crashed about 35% in a single day in some prints. People call it the worst single-day crash since 1980. Intraday lows near $74 happened from highs near $121. Let that land. Dozens of silver trading firms in India faced insolvency stories. Liabilities in the hundreds of millions vanished in hours. That is not a gentle pullback. That is a liquidation event wearing dress shoes. The same week you hear a pile of suspicious timing stories. Reports mention the London Metal Exchange going dark pre-market. HSBC systems in Hong Kong had issues the same day. Headlines talk about big banks and big trades at ugly prices. Reuters pushed a story some agencies later disputed. Correlation is not causation. A pile of weird timing is still a pile of weird timing. I am not proving a conspiracy on a whiteboard. I am showing you what forced liquidation looks like when rules change fast. Margin hikes squeeze leveraged longs the hardest. Big players can cover shorts into panic pricing. It rhymes with 1980 when COMEX used liquidation rules that basically said sell only. Price collapsed and the hunts went bankrupt. The exchange survived. Here's the difference that matters in 2026. In 1980, physical silver still existed in size. In 2026, industry still needs metal, even if paper pukes. Solar lines do not run on vibes. Samsung reportedly prepaid millions to restart a mine. That is not a meme. That is a supply chain screaming. Some people even mention gold to silver ratio signals. I am not turning this into a ratio cult video. I am saying markets were pricing extreme stories fast. Another blunt truth is that crashes do not erase industrial need. They can shake out leveraged players. They can change who owns the narrative for a week. They do not summon metal into existence. That is the scary difference between a paper story and a factory calendar. Fifth domino is policy from China that changes the world market. On January 1st, 2026, 6. Silver got reclassified as strategic material with export restrictions. Lease rates spiked hard. Premiums in Shanghai stretched far above COMEX in some prints. China is a major global supplier and the tap tightened. This is not a temporary blip only. It is part of a strategic shift. China hoards for domestic solar and EV the way it managed rare earths. The global chain did not just tighten, it fractured. If you ever watched rare earth drama play out, this is the same playbook in a different metal jacket. Export rules do not just change price. They change who gets served first when the world is short. That matters for factories more than for chat rooms. Meanwhile, big money tells two stories at once. A physical silver trust announced a larger capital raise near $2 billion in the reporting band. At high silver prices, that is serious buying power. Some people say one fund can represent a double-digit % of registered COMEX inventory in rough math. Paper silver ETFs like SLV saw profit-taking and outflows. Physically backed trusts like PSLV and SIVR saw inflows. Smart money is not treating all paper claims the same. Some emerging market central banks add silver beside gold. Institutions quietly position for a world where delivery matters. If you own paper and think you own silver, you should know what your claim actually means. If you own a physical trust with audits, you are playing a different game than a hype ticker. So what happens if COMEX or SHFE cannot deliver in March? There are 3 scenarios and none are cute for the old system. Scenario 1 is cash settlement. The exchange pays cash instead of metal. Paper price becomes fiction for people who wanted ounces. Physical price discovery shifts where metal actually trades. Shanghai and Hong Kong become more important price truth zones in the story. People tell after a break. Scenario 2 is delivery failure. Contracts do not get honored the way textbooks promise. Lawyers get rich and trust gets poor. Credibility in futures markets can die in public. Scenario 3 is forced liquidation rules like 1980. Price crashes short-term while positions get closed by force. Then the physical shortage is still there afterward. So you get pain twice in different costumes. A crash can feel like relief if you hate high prices. A crash can also hide the same shortage under new headlines. That is why I keep saying paper is not metal. None of these scenarios are fun for people who believed the contract was a simple promise. Markets can survive embarrassment. They struggle to survive a credibility break. Analyst Bill Halter put it bluntly in public commentary. If delivery failure happens in March 2026, it can cascade into currency stress and stress in the credit-based financial system. Real businesses run on credit access. If credit seizes the real economy, feels it fast. That is why this is not only a silver trader story, it is a plumbing story about trust in contracts. I can hear the objection already. People have predicted COMEX default forever. Seeking alpha-style pieces sometimes model near-zero default odds using normal delivery percentages. January 2026 was not normal delivery behavior. The patterns people relied on broke. SHFE and COMEX stressed at the same time in ways that are rare. China export restrictions are a new variable. A 6-year structural deficit is a new baseline. You can be skeptical and still admit the baseline moved. Skepticism is healthy when it updates with new data. Denial is unhealthy when it pretends January was normal. Stanford-linked research in January 2026 talked about silver in solid-state battery chemistry. Samsung is chasing next-generation supply. Even jewelry matters as a signal. When Pandora-style brands move away from silver, because cost is insane, that tells you the floor is not pretend. Jewelry is supposed to be discretionary. When discretionary gets priced out, the story flips. Silver stops being cute and starts being strategic. Industrial demand is not slowing. It is accelerating into a supply wall. You can dislike the hype cycle and still respect the spreadsheet. You can like silver and still admit volatility is real. Max Invest is not here to sell you certainty. We are here to sell you clarity. If you are an investor, not a trader, your job is not to predict the exact headline. Your job is to know what game you are playing. Physical shortage is a different risk than a bad quarter. Let me tie the room together. The opening image was a short, bigger than a warehouse, and a paper market bigger than deliverable metal. That is not a spat between traders. It is paper promises colliding with physical reality. For decades, futures set the price with contracts that rarely deliver. When delivery demand spikes 20 to 40 times normal patterns, when registered inventory falls off a cliff, when the biggest supplier tightens exports, paper markets lose control. March 2026 might be the month something cracks. Or stress might roll to May and then July. The structural deficit does not fix itself next week. Mines that do not exist cannot ship metal you need today. Every month without a clean resolution makes the reckoning bigger. If you want a practical takeaway for life, not just trading here is one. Do not build your entire worldview on a single contract month. Do build your awareness of how delivery works, because markets punish ignorance faster than they punish fear. You are not watching this by accident. If you stayed for the mechanics, you want a framework, not a panic button. If you walk away with one sentence, make it this: paper prices can lie for a long time. Delivery seasons tell the truth eventually. That is why March is not just a month on a chart. It is a test of whether promises still match metal. Key idea: the war is not trader versus trader. Key idea: the war is paper versus physical. If you stayed through the numbers and the timelines, you are not waiting for me to hand you a verdict. You are building one. The person who understands margins, inventory, and rule changes does not panic when prices swing. They recognize the mechanism. They update their plan when the plumbing changes. That is what financial education is supposed to do. It turns chaos into a checklist. If this helped you see the system clearer, subscribe to Max Invests and comment one thing. Do you treat silver like a trade, like insurance, or like neither, and why? I am Max. The paper market is a house built on promises. March is the storm season on the calendar. Whether the house stands or wobbles, you now know what is holding it up.